Al, as we get into this next topic here, there's such a wide range of results from the investors, which is the public,
Right.
and the smart money. There's a big difference there. The investors and the smart money. The smart money is always creating income, always creating returns. The average person or the public typically struggles. Now, there's a few reasons for that. Let's talk about some of that stuff. Why is there such a big gap between the Wall Street professionals and the average investor?
Well, when you look back at a volatile year like 2020, we find that even though everybody had access to the same market, some did extremely well. They had blowout years. Some lost a bunch. They had blow up years, and everybody else was somewhere in between. But as you mentioned, the pros, the smart money, they are consistent in their trading. So why is there such a difference between the pros and the public? Well, let's look at the pros first. First of all, they set rules, and they set rules to something that the public doesn't even know there are rules for. Why are rules so important? Because whoever sets them really controls the odds. It's like a casino. They set the rules, so the odds are in their favor, so they know over time they're always going to win. And then secondly, the big money, the smart money, really controls price movement. They control order flow. They're the ones that really cause the imbalance between supply and demand, between the buyers and the sellers. And they have a plan. They have a plan that's a strategy, it's a process, and they follow that religiously. And this is really important, it's really key. They know how to protect their principal and their profits. The public, on the other hand, most of them think, and this is probably the biggest mistake they make, most of them think, act, and execute like the rest of the public. In other words, like amateurs.
So what can the public do to overcome that?
Well, pretty much everything that the pros do.
Okay.
It's
So
just
kind of
that,
doing it like them, right?
exactly.
Well, a lot of people think you have to beat them. That's not the case, is it?
Well, no, you don't have to beat them. You don't have to, and you don't have to be right all of the time. I think that's one of the misconceptions that people have, or the fears that they have. What if I take a trade or investment and I'm wrong? Well, the truth is you will be wrong occasionally, but the key, and I mentioned that just a minute ago, the pros know how to protect their principal and their profits. It's risk management. That is really the most important thing. It's like anything else you do in life. You control the risk. Every time you get in the car, you put your seatbelt on. You hopefully look at the stoplights to make sure it's green when you go. If there's a stop sign, you stop. That's controlling risk. When you cross the street, you make sure there isn't a truck or a bus coming that's going to keep you from reaching the other side of the street.
Yeah. So how does somebody start that process then?
Well, first of all, you get the proper education. You get the proper education that includes risk management, not only how to identify when to get into something. In other words, when to identify the proper price. The Online Trading Academy students have access to a foundational strategy called CORE, which really is a timing strategy. It times the movement of the change in price, the movement of price in individual assets or in the markets in general. That's something that gives you the most important component of a trade. That's the right price. That really will determine the quality of your protection and the amount of profit that you can make. It's basically, it's changing the mindset of the public, getting them to think, act, and execute like the pros, having access and using the same assets that they use, and identifying, the pros are not going to call you and tell you when they're trading, but they're leaving footprints in the market. They're basically telegraphing to us when the next component of a trade is going to take place. That's really where unfilled orders become filled orders. That's where our students, the OTA students, are positioned before that happens. So anybody else that takes a position at that point, that price is going to provide a profit, a move in the price for them.
Yeah, and basically what Al is talking about, he was talking about rules. It's having an actual trading and investment plan and then controlling your odds, but also it's taking the emotions out of it as well. The institutions and banks, I'm assuming they don't trade and invest with emotions. They have set plans.
Correct.
They follow the rules within those plans. And that's why us, as the average investor, we want to trade and invest like them. So you need a strategy that's designed to do that. Al, you mentioned something interesting about the mindset. You have to have the proper mindset. And you also said the institutions are utilizing the proper assets.
Mm-hmm.
The public or the average investor is just trading stocks. which are very expensive.
Right.
No leverage. They're only open 6.5 hours a day, our time here in Minneapolis. What are some of those other assets and why are they using them? But also, are they available to us as well?
Well, in answer to that last question, yes, they are available to us, and they should be part of a plan. A plan which we think is critical to being successful includes a number of things. Number one, it includes that core strategy. That timing part of it is extremely important. But then, what are the right assets to use in different market conditions? Sometimes the market can be challenging, and it requires maybe moving from one asset to another. The institutions are doing this on a regular basis. You mentioned stock. Certainly, they will buy stock, buy and sell stock. They're not, the pros and the smart money, they're not putting their assets into and counting on mutual funds, for example, for their returns. They might use stock, but they're also using assets like the futures market, the Forex market, the options market. Those are leveraged assets, and that's part of that plan. In addition to the timing, you have to know the right assets, but be educated on how they work, how they function, because they're all different. And then the other thing that a plan provides, by the way, before I go into more detail on these leveraged assets, is it controls the biggest enemy that you have in your trading and investing. And it's the enemy that most people let make their decisions for them, and that's themselves. That's themselves acting with emotion. To properly invest and trade, you have to emotionally detach yourself from your trading. The only way you can do that is to have a plan that has a step-by-step process, a set of rules that you follow, and you follow those religiously. You don't vary from them. And then why do the institutions use leveraged assets? Well, there's a difference in how you would approach the markets if you're looking for short-term returns as opposed to long-term wealth and maybe investing for your retirement. For short-term trading or investing for short-term needs, which a lot of people have, maybe the income from your job will pay the bills you have, maybe it won't, but maybe there's not enough left over to have some fun or maybe cover some emergencies. So a lot of people are looking for something to kind of boost what they get from their jobs. Some will pick real estate, for example. Some might find a second job or try to create a business. Some look at the financial markets. And if you're looking at the financial markets and your goal is to have short-term income, short-term cash to cover short-term needs, it can't be something that you are told to hold on to for 20 years or 30 years. That's typically what Wall Street will put their clients into, is a buy and hold strategy with the understanding that it is a long-term strategy. You just hold on through corrections, through crashes. Don't worry about it. 10 or 20 or 30 years from now, you'll be okay. That's the story there.
That's the warm, fuzzy feeling.
Right, but you cannot have an emergency. Let's say that your furnace goes out and you replace the furnace and tell whoever the company is that replaced it, you'll pay them in 20 or 30 years after your buy and hold strategy is finished. They're going to want their money right now. So there are things we can't control necessarily, but we can control our ability to access the markets for short-term income. And that's one of the things that the Online Trading Academy does, is they teach their students how to trade for short-term income and how to invest for long-term wealth.
Well, you need a strategy that's designed to teach you to do that. There's no guarantee, but there's different techniques and strategies for that short-term style of trading and that longer-term style of trading. Futures and Forex would be examples of those.
Exactly.
So with these different assets, I mean, they're not new. They're just a little bit different, and most people just haven't been exposed to them. We're exposed to the stock market. Unfortunately, and this is a big unfortunately, people are exposed to mutual funds.
Yeah, most people listening are probably in mutual funds.
Yeah, which have high fees. I mean, and they underperform the market. I believe the stat is 90% underperform the market. I know we're going to talk about some of that stuff here in the next segment, but there's a lot of people that want to understand, what are these shorter term assets? How can people utilize them? Well, the futures and Forex market is actually open 24 hours a day, so people have the opportunity to trade and invest at night. So Al teaches investing classes that we do right here at the Academy, and he goes right into futures, what those are, Forex, even the options market, how the leverage works, and how to utilize a structured plan to have a protected position. So there are different ways that you can do that. Al, coming up next, I want to continue this discussion about these leveraged assets. I want you to describe what those are so our listeners understand what those potentially could be that they might want to get into. They're kind of tangible, just like stocks, but I want to refer that in the retirement style of investing. We'll be right back.